Well, it's finally happened. Bitcoin's ETF has been approved by the SEC and it's sent markets back up, with Nvidia also breaking out in recent days. But what's more important is going to be the next 48 hours. CPI is coming, which is the inflation report, and we know the big earnings season is about to kick off. What types of dark pool transactions were going on over the last couple of days when it comes to the S&P, Tesla, and of course, what's going on in crypto? That and more coming up in today's show as we discuss stocks, commodities, and cryptos together. Well, welcome back, everybody, to the Daily Show where we discuss macro, lead indicators, and the hottest charts together. My name's Tom, and we've been running this show for over 3 years. If you love markets like we do, then remember to subscribe and smash that like button. Let's talk the last 24 hours. We basically moved back into extreme greed ahead of the CPI readings, which are coming out 1 hour before the market opens on Thursday. We also know that we have earnings season kicking off, and of course, that big news about the Bitcoin ETF. Just a quick reminder, sign up for our free weekly VIP newsletter, links in the description down below. Now let's talk about what's been going on from the macro perspective for markets and of course what lead things we're starting to see around the world in terms of opportunities out there. Well, this is a little bit frustrating, and this is the CTA positioning we've been talking about. We saw CTAs drop into the start of the year. They started dropping at the last week of 2023, and then they dropped into the first week of 24. But it looks like with updated data, they bought the dip in this case, and they actually picked up the market a little bit, driving it to a new high. So CTAs are pretty well positioned. They're getting close to that extreme level again ahead of CPI. And we will see some dark pool transactions later on today that could still suggest that there are some sellers around these points. What about the markets from an options perspective? We know 4,800 is a huge gravitational point this week that could act as resistance. We're ahead of the CPI, so we know that this level is going to be a big one. And markets went from negative gamma back into positive gamma throughout this week of trade. So that's something that's also switched here. Could we be looking at a 4,900 plus high? You can already start to see that that's where we're starting to mount a bit of a push in terms of overall options, and 4,850 is also another key point. That being said, it's really going to come down to these two catalysts, CPI and, of course, earnings season. Gains are common in years such as election years, which is where we are right now, but do remember it's very traditional to see weakness in the first quarter. And there are some stats coming up in today's show that show you that January into the first quarter are, based on what we've seen so far, going to be volatile, and there could be significant weakness around this point. I also want to mention that it looks like Goldman Sachs indicators are showing that there could be some flow coming back in to oil. You'll notice here in most of their base case scenarios, and again, this is just a scenario, you have to apply this with technical analysis. We'll look at oil later on. You can see the simulated returns are mostly towards the positive or sideways side. Now, it makes sense because where we see ourselves in oil at the moment is a very critical level, a huge support zone that has been held for many, many months before. So we know that we're at a big support or demand zone. What we don't know yet is how high oil might retrace back to. We've been talking about mean reversion, and we'll get into that later. CPI is probably going to be one of the catalysts that could cause this to occur. So as we know, markets are usually bullish. And don't get me wrong, this year still looks like it's going to be a positive year by the end based on every stat we've seen. It's really a question of January and Q1 that becomes to mind when it comes to traders and seeing what's going on in the charts. We do know that when we have a negative 5 days and we have a failed Santa Claus rally, we tend to see stats that are pretty unfavorable towards markets. And this so far, we haven't seen a sell-off occur, but if we do start to see weakness under certain zones, such as 4,700, we will know that markets are going to get, I would say, kind of volatile, and mean reversion probably is incoming again. Q1 also only has a 50% coin flip, which is actually under normal market stats, so it shows you again that weakness could be there. If we just look at the S&P 500 first 5 days without the Santa Claus negative rally point, you'll notice that we still get 34% and a coin flip for Q1. So realistically, this year is going to be up, down, and all around, and it could follow what normally happens, which is some weakness in January into March, rally through the middle of the year, dump into the back end of the year as we head into the election, and rally from when we find out who wins. Let's talk about some other stats coming forward as well. This is, of course, Something we don't know yet, which is going to be that we're going to look at two things here. We're going to look at the last 2 months, November into January, the T plus or Wayne's Toy 2 month, which is going to be pretty important. And we do also know that based on some of the stats we saw before, these are the reads for the next week. So this week so far has been bullish. Generally speaking, it has a negative tinge to it. Next week usually has a negative tinge to it as well, and then it gets more coin flippy. So if weakness is going to happen, you generally expect it around here, but we just don't have the catalyst that happens yet. For the bulls, the big thing is, yes, okay, the markets are overbought. Yes, okay, you've got RSI and you've got every other indicator showing everything's overbought. But at the same time, when we tend to go into 8-week, 9-week style S&P 500 movements up, you might think, well, markets have to pull back. Well, the suggestion is that isn't actually true. And it looks like in previous occurrences, which we have 18 previous times to this one, 4 weeks, 13 weeks, and 26 weeks later, markets were still more bullish than negative. So just remember, just because it went up a lot doesn't mean it has to fall. Another big bull stat as well for the rest of the year is going to be that we generally have midterm election year weakness. When we do have that, pre-election and election years do tend to be positive. In fact, the read is 100% of the stats. Now, you might say, well, we only have a few reads, but we still have quite a few, I would say 5, 6, 7, 8, and 9 reads before. So this will be the 10th one. That's not too bad when we're going from 1950, and I think it's an okay data point. This is the 2-month toy numbers that we see here, and we'll figure out whether we get that soon. And do remember that we've been talking a little bit about the Russell 2000 seasonality for a while now. Back in December, we talked about it very strongly. It performed better than the other markets. It's currently lagging some of the other markets, as in the S&P and the Nasdaq. If it's going to do well, it tends to do well into the beginning of February and then drops off quite substantially from that point. So these are the days that tend to be positive and negative from before the year to after the year, something you might want to take a snapshot of. Now, we've been talking a little bit about China and the fact that the market's getting absolutely destroyed over there. And of course, every negative piece of news you can think of is coming out. We've got bankruptcies, we've got new filings, we've got weakness in the economy, we've got anything you can think of is really happening. But interestingly enough, underneath the kind of hood of the market, we're starting to see call open interest improve. And this is actually going back up quite a lot into 23. Now, people are starting to speculate back on this market, and it could be an interesting catalyst that could lead into maybe a little bit of gains. We've seen this type of thing happen before, leading into market movements. We often see that it sometimes precurses some movements in the market. So it's something that's there, and of course, price action will be the dictating trend. And at this stage, the market has still remained very weak. We'll look at it later on in today's video, and we'll talk about it then. Let's also discuss earnings season. We know that it's going to come down to really actually getting good earnings growth. Follow the channel because we'll be talking about earnings beats versus misses this year and figuring out whether we're actually getting a strong earnings season or not. And we'll know that over the next 2 to 3 weeks with most of the big ones starting to come out. And if we don't get the earnings that Wall Street expect the market to act very negatively towards that. It needs to be driven by some form of earnings growth. So this is going to be an important factor because that's actually what's led into a lot of the market moves over the last 12 months. Let's talk about Friday. We know that we have JP Morgan, Bank of America, Wells Fargo, and Citi kicking it off. So banks are all sitting right around those critical break points where if they break out, there could be a nice rally on the cards. And if they weaken off that area, then you might start to see weakness across the board. We've already talked a few times, and go back and watch 2 of our other videos where we talked about Goldman Sachs and the possible distribution of large trades at this high. Somebody's probably selling off a little bit just in case, but if it does end up breaching down, then it shows you that somebody knew, and that's going to be that catalyst that we're looking for. Friday, as you know, all these banks are reporting. These are the expected moves, Wells Fargo and Citi, the 2 highest based on options. Now, we've talked a little bit about dumb money, smart money, confidence. We've talked about how sometimes when it gets a little bit too extreme, which is usually where we get those extreme greed reads as well, we tend to lead into a period where markets can be unstable. That doesn't mean that markets don't go up during those periods of time, but in a general speaking, when we get reads like this, we do tend to go into sideways or little bits of pullbacks. And there's only been one period of the last 4 that we've actually had a market rally through it. Now, that was back in 2021. So it's again just another little bit of a sign that if things start to weaken off, we move underneath key technicals, we've got to be cautious at that point. Okay, let's move over now to the largest trades that have been going through. Now, I've got here a heat map, and what you'll notice is there's a lot of trades. There are a lot of trades up here on the SPY at around that 474 to 475 zone. So we're still trading just a little bit above this, but basically this area here has been huge, and we've seen some large prints off it. Now, we also saw prints coming in recently to the S&P. Now, you'll notice that there were big prints down the bottom here. They led into huge rallies throughout the rest of the year. At the end of 2023, we saw some large prints as well. It could show you that somebody is taking profit. Notice that the print differences, we've got some down here, we've got some up here. Some of the biggest ones were at these two extreme highs. Not much to go off there, but what we do know, actually, we'll go back here for a second, is that we have a lot of trades that are coming in on leverage trades as well over the last 24 hours. So basically up around here on the SPY, we've had quite a lot of largish trades. It could suggest positioning either to the positive or negative. We have some levels that could be catalysts for those trades. And as we like to say on this channel, it's more of a patience, react, don't predict. And we'll talk about that as we get into our S&P 500 analysis together. Let's move over to treasuries. So treasuries, of course, dropped. This is in line with what we've been talking about. We've already seen large transactions before. In fact, we've seen plenty of transactions up here with treasuries, and we got another large one near the low. Now, if treasuries move lower again, then that probably shows you there's more to come in terms of how low it can go. 93, something we've been playing with a few times. If we do end up getting a low, takes the low down here and then bounces after the CPI news, then we probably are looking at a little bit of a relief rally for treasuries. So a lot of this will come down to yields, and we'll look at that very, very soon. Let's move over now to options and take a look at the big trades that we're going through. First up, we had pretty much on the normal levels. Now notice we had 48% puts. So we've been averaging around 56 to 58% calls recently and a lot less puts. So interestingly, into the CPI event, a lot more people went negative on the market, 39.5. It probably explains why the market was able to move up a little bit as well around these levels. And you can see here that the big trades coming in were actually a lot in the energy sector. So we had a lot of puts coming through in two of the energy sector areas, both XLE 309,000 puts and Exxon we saw 154. So the call put ratio, look at this, into the CPI, two massive options markets getting in there. Will the puts act as kind of like support for the markets, or is this an early move on it? That's going to be an interesting one. We'll look at the key levels for oil coming up. Some other things to note where we had pretty even kind of levels, I would say, for things like the Qs and S&P. So effectively, these markets here were pretty much trading within harmony. Let's move over to what was going on in terms of sector rotation. The 5-day rotation now has moved from defensives, which was healthcare, staples, utilities, to semiconductors outperforming with tech, with communications. This is traditionally what you usually would see before a breakout to the upside, or possibly if it was like a relief trap. But yeah, that's an interesting one. That's a big rotation back into them. And you can see here the last 24 hours, we still have some defensives holding in the middle, like healthcare and staples is now down the low. Remember, when we were rallying back in the end of 2023, we were rallying with all the right market sectors, and all the negative ones were, really staples, healthcare, utilities. They were pretty much marking some of the worst returns day on day on day. That's starting to flip a little bit here. Let's jump into the charts together, though, and take a look at what bonds are telling us and what, of course, every other indicator is telling us, plus the key levels. First up, we have central banks. Central bank liquidity has not made any major change yet, so it's sitting firm. If this starts to drop off, markets hover or rally up more, that will be a big cause for concern. We'll be looking for catalysts. Again, hasn't shown itself just yet. Let's move over now to yields. And straight away here, we've got the US 10-year. Now, we've already talked about how it's above the 20 moving average. And this is a key thing. So basically, once it's above the 20 moving average on the daily, it's suggesting that we could move towards 4.2. And do remember, 4.2 ends up being a very important point because it is mean reversion. It's back to the 20 moving average. Now, it could be the CPI gets us there. We've already talked about the set alert, this level down here that we already had kind of, marked out. We've also got 4.2 marked out for a big key point. And I think that this could be something that we need to be watching. Another one that we need to be watching is going to be percentage of stocks above the 20 moving average. You can see here that only 43% of stocks are above the 20 moving average now, suggesting that while we're rallying, at the same time, it's only particularly some stocks that are rallying, mostly tech, mostly semiconductors, and that's really what's pulling the market. The rest of the market's actually acting kind of weak. Now, if we can get back into something like a 25 or a 20, this is where more of an investor or swing trader is going to start looking at the market and say, oh, this is looking a little bit better, more interesting, those types of things. Really, we're in nowhere land at the moment when it comes to overall market oversold or overbought kind of levels. We're in the middle of nowhere. Let's move to treasuries. You can see here the weakness coming through. No new low just yet, but we've talked a little bit about 94, 93 on treasuries. And this is coming off the back of those huge trades that were up here, the island reversal, and what was probably inevitably needing to happen. Now, I would like it to go down here because I think it makes more sense to the overall story. We price in 7 rate cuts for this year. I think that's too many, but anyway, whatever. The market does what it does. Then it rallies back up, kind of starts to price in maybe more like 5 to 6, and then we find out whether we can get back into 7. But at this point, it's makes sense for it to come back down to these levels. And you can see here as well, if you look at mean reversion, and again, you can see this 20 moving average is really key here, that this would hit into around 94 to 93. So it makes sense to get this pullback. 2 bad weeks as well of rejections. It's been a pretty strong chart, I would say. Let's move over to our bond indicator. It's been rallying in recent days. So you can see here 2 strong days coming out. 1 weakness though. So this is the Wednesday trade. So Wednesday's been weak ahead of the CPI. If this drops off, the markets go up. Very worrying sign. So at this point, we only got 1 negative day. If we keep seeing maybe 2 or 3, remember it precursored the sell on the markets. 14th, 15th, all the way down to the 20th. We started to see weakness. And then, of course, the end of the year, we started to see weakness and we dropped off into the start of the year. So really, this is going to be a very important indicator moving forward through the next couple of days. Dow Jones Transportations, they were up a little bit, but still underneath. The double top is still in play. No movement towards the take profit side. Home builders, also one that we've been looking at. Yeah, it's just kind of like floating around at the moment. No real significant weakness, but no incredible strength either. Let's move over to the US dollar. So the US dollar is in really a trapped area. You could make arguments, as we've already talked about before, to try to sell that area there. I'm not doing anything on the dollar at this point. I would say it's kind of trapped within this zone. Is this accumulation? Is it distribution? We don't know yet. I mean, the suggestion would be still, you would usually go towards, okay, well, dollar should be weak because the trend is currently down. Fair enough. Key point. And we know that we haven't been able to get a daily above this area yet. So we're going to set an alert here. Let's set an alert together. And we're going to set alert for around 102.41. And we'll also set an alert below this point because I think that both these areas here are going to be, I'll say that later, both these areas here are going to be points where you would want to be looking at the next available zone. So if we see dollar move above this point, I think that 103.80 to 104 is going to be the next level for the dollar. And if the dollar does fail and gets underneath here and closes, we're probably looking at a new low on the dollar and for it to go through that 100 barrier. So some big levels coming up for it. I think the dollar is going to move relatively, pretty significantly. Based on yields, you would think the dollar might move up because, of course, yields are broken a little bit towards the high side. So we're going to lean towards actually the counter trend at this point. You can see here as well, if you look at the trend line, that we're really sitting on that trend line. So some very important stuff happening here over the next 24 hours. Gold, incredibly hard to read. We're not at an extreme like a 2003. We're at the most traded zone. So realistically, this area here is kind of like equilibrium at the moment for gold. We know that when we got this read over here, we had to be incredibly cautious. We've talked about sideways action since then, and it's been exactly what it's been. You might say, well, Tom, it's been up and down a lot. It has, but still, the overall result is sideways. Now, I'm expecting gold to do decent things in 24, so we'll get back into it soon. But for now, no really large reads. US oil. So this is an interesting one. Down the low here is where the buyers sit. We mentioned that in our last video, and we saw some little rallies. Have we gotten through the trend line? No. Have we gotten through the most traded zone? No. Are we confirmed into a bullish trend yet for this particular pair? Well, the answer is unfortunately no, we're not. But we do know that we're at a huge level of demand. And remember, Goldman Sachs also had this as their scenario of kind of like sideways action, or 2 scenarios were actually more bullish than bearish. So in this kind of area, you could say that this is where demand is. It's very important. If we end up dropping like a 67 a barrel on WTI, that's going to be really weak for the market. It's actually going to show you some significant weakness across the board, and most likely yields will be getting cut plenty of times. So this is such an important level for oil. Make sure to be watching it this year. I think it's going to be quite important, especially if it breaks below that 67 a barrel. Let's move over to single stocks now. First up, let's talk about Tesla. So we know here already we have an interesting level. We have a big accumulation zone. We've actually managed to get down here. Now, I've got a couple of alerts. So the first one is above this high. We already spoke about this. If market was able to get above 243, then it would be pushing towards that strength. For day traders, you're actually going to want to look above 236. And the reason is because we actually have come down into this accumulation zone, and we've seen a little bit of a shift. And if we manage, you can see here's already a rejection candle. So if we manage to get above this, we're getting above 200 moving average, the 20 as well on the way down here on a 2 hour. We're starting to move into that kind of more bullish territory. It's more speculation, but yeah, I think 236 is going to be an interesting zone here for Tesla. And obviously this is the level that has to hold for the bulls. You can really see it when you go out to the daily and the weekly, how important this level is. And so far we have seen 2 weak rejections, 1 here and 2 here. So somebody's trying to buy this level. Whether they'll be able to hold true to it, we'll find out. There were a couple of dark pool transactions, but they weren't massive yet on this particular pair. So obviously a very important point at a critical right ahead of this big news coming. And remember, earnings isn't very far away either, only 14 days away for Tesla. Let's move over to Nvidia. So this is a breakout everybody's talking about. Everyone wants to know what's going on with Nvidia. So you heard before that 600 was on that chart. Well, I think I agree from that perspective, from a technical perspective. I mean, 600 is the obvious technical breakout. We get A equals B. This is accumulation in this case, and it's moving up. Now, of course, if you were in Nvidia, you're going to be very happy. Series of higher highs and higher lows, markets rallying up, no problems there. The issue is going to be if markets end up weakening so heavily that they end up putting down a weekly. Like, let's say the next 2 trading days are horrible and Nvidia rejects, then this is going to become what we would call a UTAD or a UT from a Wyckoff perspective, and everything would change. Now, that's prediction. We don't know that's going to happen. If it did happen, then we would have the patience to know that's occurring. But at this stage, bulls would rejoice. I mean, basically, there's no reason to say anything negative is happening just yet. The market's very bullish. It's moving up through. It looks like it wants to run away. Everybody's been talking about it. We discussed it in our Monday live session, and we even had this as the theoretical target. Now, I do know Nvidia loves its good false breakouts. We talked about that previously over here. We actually got it back to the zone, which was this blue zone that we talked about. And if you did buy that, well, I guess you'd be pretty happy with yourself, because in here, the returns have been quite good so far. That being said, yeah, 600. And if it does get up to 600 around here, I'd expect some very large reactions on the market. Let's move over to AAPL. So it's been rallying up here a little bit, and it hasn't gone back to extreme bear level. It's kind of in the middle of nowhere. So a few people have asked about it. I don't really have an extreme read on it. It didn't get quite down to our fantastic buy zone. It also didn't get back to the bear zone. So I would say it's in the middle of nowhere. 188 is going to be a little bit of a zone for it, just because it has a few different indicators sitting on top. But yeah, we'll find out how that one ends up reacting. Let's move over to major indices now. German markets to start off with. So German markets holding in firm. No significant weakness yet. We came down to this level. So I think the German market's a little bit tough to read here. Aussie market, we know its resistance. We know a breakout is significant, and we have alerts above that. If we get above, for the Aussies out there, 7,800 is the next level, and possibly even 79, 8,000 would be on the cards if we see a breakout across all markets. So something to watch. But if you look at it here on a weekly into a daily, you can kind of see it just came back to the daily 20, and it's holding firm for now. S&P will really move that one. Now, the US 2K, it's playing catch up at this stage, because remember, it's behind the S&P and Nasdaq in terms of recovery. They're more here. Russell's more here. So we'll find out how this next 24-hour trades into the next earnings season. But basically, we have seen some buyers come in here. Now, do we have extreme reads? We do know that there are some wicks here, 1, 2, 3, 4, 5. So That's kind of positive, I guess. If the market does fail underneath this, I'm going to mark out just a level here of 1950. I think a closure under there could really signify an 1860 mean reversion style move. If we go to the 2 hour, you would not be stupid necessarily to have attacked this level here. 1950 is a pretty good zone. For anyone that's done our day trading masterclass, you would know that that's a pretty good level. It's fairly tight. It's quite good. It's got good reactions off it. Of course, you'll need to be cautious. I wouldn't mind to see the futures market get into this point. Maybe you can get a break even in around there for the CPI result, but it does show you there's plenty of opportunities out there. That was actually a pretty good level and fairly replicable. So you could have had that one set up and then had that kind of key level to pull off. Let's move over to the Qs. So it managed to get a gap fill just before CPI. You can see here the long leg doji, the big move down where we sold off very aggressively this year. We've rallied up to the gap fill. We discussed in the previous video the chances of the Nasdaq finding some weakness around this level. We also discussed that we would need day trading confirmation. So we didn't get any lower lows. So remember, the key here is always to say, okay, cool, we're up to a key point. Is this important? Yes, it is. If we are going to go for the short side on here, what do we need it to do? We need it to break some form of structure. And it just didn't do it. It keeps going high, low, high, 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 low, high, 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 low. And it keeps doing that sequence. Now we find ourselves at this little supply, which obviously is the Q kind of gap fill. But I'm more interested in the S&P now because the S&P did create, and we'll go down here to the 2 hour, it did actually weaken where we discussed it last time, which was around this level. We obviously talked about 4780 also being key. The reason it's going towards 4800 is just purely the high plus the calls. So it's positive gammaed into that level at this stage. But unfortunately for bears, it's not going to be easy. You know, this was actually what I was looking at. If I was able to make a video, and sorry I couldn't yesterday, unfortunately we had a family emergency, so I had to attend that. Overall, we didn't see a lower low. So if this had gone down like this, yeah, I would have thought very negative. And it actually did what I kind of hoped it did. Went here, went up, came down, wasn't able to get lower. Now, if it did, everything changes. And that's technical analysis. That's actually getting edge on markets. Having some kind of opinion maybe, sure, but really only triggering it when the market tells you it is safe to do so. So yeah, very important point here, 4,800. This is an options level. If we manage to beast through 4,800 and close, then it's off to 4,850 and 4,900 next. So yeah, a lot at stake here into this week. Now, let's talk about Bitcoin. 2 long leg dojis, and the reaction so far between 47 and 48 have been exactly what we expect, which is sellers have come in through here. We've talked about this level for months, and 47, 48 has always been one of my major targets for Bitcoin. At the before the halving cycle, I have higher targets afterwards. So this is a key level, and we've seen the types of reactions that I would expect. At this point, we saw that weakness, and then we came kind of down. We see weakness again. Now, we haven't broken underneath key levels like 43K yet, so the trend is still theoretically up. If you were looking smaller time frame, you would be trying to sell into here with stops above this high. But look, that's going to be going against every narrative you're hearing right now. Bitcoin ETF, how amazing is this? That's what you're going to hear. It is good. You're also going to have a lot of hype in there. It's just whether the market chooses to do the buy the rumor and sell the fact that often does occur around these periods. We're at a critical zone. Don't get me wrong, most major trends are up, but there are bearish trends on the smaller timeframes. We'd probably say 1 hour and below is bearish at this point on Bitcoin. Good luck out there on that one. It is always a tough trade. Well, it's not always a tough trade, but sometimes it really can be. It's easier, of course, on the buy than the sell. So we do have CPI coming through 8:30 a.m. And then, of course, we also have PPI coming on Friday, along with those big earnings numbers. Make sure to stay tuned to this show. We'll be covering everything we can together. And of course, we hope that everybody is having an okay week. And if you are feeling bearish on the year, just remember the stats are technically positive. The overall year should really be green based on everything we saw with thrusts and everything last year. The question is really going to be around this first Q1 and whether we trade the normal patterns. Weakness somewhere around here for the first Q, then we get into that strength period mid-year, then we get weakness again, and then strength ideally into the new presidential cycle. All right, thank you so much, everybody. Remember to subscribe, sign up for the free weekly VIP newsletter, and and we'll see you in the next video. Bye for now.